Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, November 1st. Hope you guys had a great, wonderful Halloween yesterday. We got a few economic news releases scheduled for today, so we'll jump right into it. We'll start off with the market PMI for the month of October. So last month, September, we had a 53.2 on the index level here for this is a manufacturing number here. And anything above 50 is considered expansion. Anything below is contraction. So we've been just above it. And we did expand a little bit even further in the month of October to 53.4. So heading in the right direction was obviously a good sign, especially after yesterday when we had the Chicago PMI showing a pullback and basically just hovering right over at the par level there. We also got another manufacturing number with the ISM for the month of October. So we had again, same thing as the market. Anything above 50 in this one is expansion. Anything below is a contraction or pullback. So we had 51.5% in the month of September, and forecast was 51.7, and it went 51.9. So good numbers right there, popped in a little bit higher than expectation. We like obviously the seeing manufacturing going up. Obviously went up a little bit, but not a lot. But again, it's better than contracting a bit, especially when we're considering that it is fall and usually manufacturing will pull back a little bit during the winter months. Construction spending continues to drop. As you can see here, back in August, we had a 0.5% drop. Forecast obviously was up. We thought it would go into positive territory at 0.4%, but it dropped, it pulled back again another 0.4%. So continuing heading into the fall here. Stock market's down a bit, so expect a lot of choppiness over the next week or two, primarily because we got a lot of major things here. We got the Fed starting their two-day FOMC meeting starting today. Tomorrow they give their announcement. Friday we got jobs numbers coming out from the Bureau of Labor Statistics, and then next week we got the election, presidential election coming in, and a bunch of local ones as well. So a lot of choppiness as the investors are a bit uneasy, especially with the email situation that could be a game changer with the Clinton, who was leading the polls. And now that Trump's in there, that they didn't really price in Trump, they were kind of pricing in that Hillary would make it. So the markets are a little uneasy on the political level. Also, oil continues to decline. Now we're down just under $47 a barrel as the hopes for a cap on the productions continues to wane. So, and then of course the big one right now is global yields. So this is what's kind of, even though the stock market is down, the bond market's not rebounding as much as we'd like. A lot of that money, instead of between those two, is actually going into the 10-year treasuries, which is even more conservative. Just because of all this uncertainty, a lot of investors just want to put a more conservative route versus mortgage-backed securities. Typically, we would see mortgage-backed securities rejoicing when the stock market's down, but in this effect, it's even bypassing them, going even more conservative route into the treasuries. Especially now that we're about just over 1.8 on the U.S. 10-year Treasury. The German Bund, which was a matter of about 30 days ago, was negative, almost negative 0.2. Now it's on the opposite spectrum of up almost 0.2. Not quite, but almost up 0.2%. So, and then, so let's go ahead and take a look at the bond market. We're breaking below this important barrier here. This is the 200-day moving average. We haven't been below the 200-day moving average in approximately about a year right now. So we could be seeing higher rates coming up, at least in the foreseeable future. Again, one thing that could help us out later today is we're expecting the New York Fed to be purchasing about $2.5 billion or $2.25 billion worth of mortgage-backed securities, which could help us hopefully boost us up above the 200-day moving average. Again, we've been testing this quite a bit. And this is, with this scenario, it's kind of looking like we could be breaking below there, and rates could be rising here in the near term, at least up until we get some certainty after the election, and maybe money will come out of the treasuries and start going back into one of the stock market or the bond market, as to which it feels more comfortable about. All right, so rates have went up today. We're down currently about 19 basis points from where we left off yesterday. So just be cautious. Again, we got a lot of volatility going ahead and a lot of uncertainty, especially when we're testing this 200-day moving average, and there's a chance we could potentially break below this and stay below this for a little bit. So So that kind of concludes. If you guys like to get more updates throughout the day, though, however, I do post more days or more updates throughout the day up until the close. And if you guys just follow me on Twitter at Mike Bjork, and here's the information right here. Hope you guys have a wonderful day. We'll look forward to seeing you guys tomorrow, and thanks for watching. Bye-bye.